orders such as stop losses and other risk management type orders. We're going to try to approach this from a beginner's level. So if you have any questions on the basics of maybe placing an order, whether it be a market versus a limit versus a stop limit, stop loss, like what does all that mean? This is definitely the session for you. We always try to encourage clients to ask any questions and to participate with us as best as possible. So if you have a stock, an ETF, some kind of indice that you would like us to use as an example, go ahead and put that in the Q&A. As well as if you have any questions, like, hey, what is the difference? Or, hey, I saw this trade happen. I didn't quite understand it. Can you give us that example? We would love to use it and comment on it to the best of our ability in this session. The goal, Peter, really is for someone who is newer to these orders, or even someone who's more intermediate, but never really quite got around to using some of those more advanced orders, to walk away from today's session more confident and more knowledgeable about what choices they have available to them. Whether or not you use it, of course, is up to you. Just a few administrative things I want to get out of the way real quickly here. Just want to point out I am screen sharing the calendar for the upcoming week, or what's left of the week, I should say. Today is Thursday. But I always try to present this at the beginning of a session just so everybody at home has it. Take a screenshot, a picture, whatever works for you. I'll make sure to get around to sharing this at the very end for clients as well. And with that here, Peter, I just want to hop into some of the slides and just set the expectations for today's session. We are going to use a little bit of slides. I'm not going to lie, they're a little bit older, to be honest, but the concepts are still very, very relevant. No questions about that. But what we'll probably end up doing, Peter, I think after we spend maybe 5-10 minutes, maybe 15 at most on the slides, is just to go into ATP and do some demonstration. How do we use these different orders? What are some of the limits or limitations? What are some examples in which we might want to use them? What does that look like, essentially, the application? For clients who ask about if this session is going to be recorded, they're always recorded, but this specific session won't be posted onto the website. But at the very end, if you stay to the end, I will make sure that I cover some of the recorded content that we have that might be similar to this and give you some resources that you may want when it comes to stop losses and some of these more advanced order types. Okay, with that, Peter, I'll start us off. We'll just hop into some of the very, very basic levels, and then we'll just kind of go back and forth. If that's cool with you. So yeah, goals of today's session. I kind of already touched upon it, but it's on the slide, so we'll talk about it. Review different order types. So market versus limit, stop loss, stop limit, etc. Probably more on the later half of the session, we'll talk about using and applying technical analysis as a means to an end in determining a stop loss level. We can do that both on a manual basis, but actually there's some third-party tools or third-party analytics firms that we integrate into Fidelity Tools that will do that for you to a degree. So we'll talk about that. And then lastly, but probably most importantly, is going to be the proper use of risk management. And what I would really just say here, folks, is every tool has a job, right? Hammer wants to put a nail into something, a wall, piece of wood, right? Screwdriver puts a screw in. Each tool has a specific job that they excel in. The reason we're focusing on stop losses today and some of those more advanced order types is because they're commonly going to be used for risk management. Like, that's really the focus. Yes, there's a bunch of different order types out there, but the reason we're focusing on them is because they aid you in risk management, which we'll talk more about as the session goes on for sure. All right, so what I want to do real quick is just get a gauge of the room here. We've got a bunch of folks with us today, which is awesome to see. When it comes to these order types, we have your basic market order and your basic limit. Again, this is a beginner session, and we don't want to go too fast or talk over anybody, of course. Raise your hand, and of course, no one else can see if you're raising your hand besides Peter and myself, if you don't understand a market or limit order, just so we can know. I want to get a sense of the room. And be honest, if you really don't, there's no shame. That's why we're doing this session. But sometimes most of the clients are familiar with these, and we just kind of skip over them and we move to the next section. But if a bunch of people have no idea and really feel uncomfortable, we'll definitely make sure to slow down the gas and cover these in more detail. Peter, I am seeing a couple people raise their hand. So we'll spend maybe just 2-3 minutes covering these topics, make sure people feel pretty much solid. For those who have your hands raised, what I want to do is, after we're done talking about these, leave a comment in the Q&A to let Peter and myself know if you feel better. Like if we've answered your questions, if you feel like you've got a solid understanding. If you don't let us know, it's kind of hard to really tell if we hit the mark there. Okay. Does that sound fair enough? Okay, sweet. So, Peter, I'll start us off with a market order. So, what is this market order? Probably the most simple and most commonly used order by retail traders. And when I say retail, I just mean everyday folks, Peter, myself, clients at home watching, right? So, a market order allows you to place a buy or a sell during market hours for an immediate execution of a trade. So think about it as like a buy now, sell now. Like the second I click this button, I want something to happen. Instantaneous, right? There's all these different reports that come out about the trade execution quality in the time frame. In these market orders, I've seen reports from Fidelity that get executed in less than a second, less than a tenth of a second. It's like 0.012 seconds or something. So it's near instantaneous. Okay. So this market order you can place for a buy or a sell. Like, hey, I want to buy shares of a company. So Sastry, if I'm saying that name correctly, put a symbol AGQ. So we could say, hey, buy 5 shares of AGQ right now with a market order. As long as the market's trading and there's no kind of systems collapse, there's enough liquidity, enough people buying and selling, that order is going to go through right away. However, there's a key frame or key consideration here, Peter, which is at the next available price. So you can't specifically dictate the trade execution price. So you're like, hey, buy it now at whatever the price is. Now, given modern times, we can see quotes in real time. So you kind of have a pretty good idea of what that price is going to be, but it's not technically guaranteed that what you see on the screen is what you're going to get in that split second it takes for that execution to go through. You can place these orders outside of standard market hours, but they're only eligible to be executed between 9:30 a.m. and 4 p.m. Eastern time. So standard market hours. I say that because it could be 6 o'clock, right? You come home from a long day of work, you say hi to your spouse, your kids, whatever, you hop onto the laptop, and you're like, oh, geez, I want to place a market order to sell a bunch of stuff at the open tomorrow, but it's after hours. Can I place it? Yes. Yes, you can. No problem. So you can place a market order technically, outside those market hours if you want to try. And I think the website might limit you or might give you a warning. It kind of depends. You can always call Fidelity and we can make things happen if necessary. But at the end of the day, the order is only eligible during standard market hours. Okay. So 9:30 a.m. to 4 p.m. Eastern time. Last consideration here for a market order, Peter, is that it's meant for, or I shouldn't say meant for, but more commonly used with what we call liquid securities. So things that just trade very easily back and forth. They have a lot of volume, a lot of buyers and sellers. Names that come to mind is like Apple, Microsoft, SPY, an ETF that tracks S&P 500. Like those are things that kind of everybody's heard about, most likely if you're trading in the stock market, right? But if you find some obscure small cap pharmaceutical company that might have the next miracle drug, well, that's great, but I don't know how many people have heard of it. If you place a market order, you might get a different price than you expect. So just be mindful of it. Real quickly here, Peter, I'm going to hop into ATP just to demo what that looks like real quick, and then we'll come back to the slides. We'll hit the limit orders, and we should be good covering those 2 basics. So here in Active Trader Pro, up in the top left corner, if we click on the trade button, this will pop open a trade ticket. And we'll pick on a few symbols that the audience gave us. So again, Sastry gave us AGQ. I'm not actually too familiar with it, but that's okay. No problem. So once we type in the symbol, we get a quote down here below. Now, this is real time as real time gets, right? So as good as the internet connection is and everything else. So what is the symbol? What is the last trade share price? What is the bid and what's the ask? And how many shares have traded today? Now, we can obviously compare this against something else, like here's SPY, right? And we can see how much more frequently this is going to move because the amount of liquidity. Or we could switch to something like Apple. But the idea is if we go to buy or sell, in this case, we'll use an example of buy. Let's say we want to get 100 shares. The order type, that's kind of what we're focusing on here today, is the order types. This market is the default because that's the most commonly used. Time and force is by definition going to default to day because you're saying, hey, buy it right now. Well, that right now can only be good for today. Lastly, it's going to say, hey, what's the expected cost, which is simply going to do the math of 100 shares times the ask price. But this could change because a market order doesn't guarantee your next price. So see how this is moving a penny here, a penny there. Well, once we preview and we place the order, we're saying, hey, buy 100 shares at the market price at whatever it is. So by the time it goes through, it might be a penny lower, penny higher, could be a couple pennies higher, just depends on what's happening. If you place a market order, let's say during an FOMC announcement, um, like let's say some kind of big product announcement comes out midday, then you can see a really big move, pennies, dollars, tens of dollars. So a market order may or may not be applicable or appropriate at that point in time. All right, Peter, I'll pause there for a moment. A little bit long-winded, but I want to make sure we feel comfortable with a market order. It's very common, and if that doesn't make sense, then the rest of what we're going to talk about won't make sense. So I want to make sure we feel solid and good. I'm looking through the questions real quickly here. For the folks that had raised their hands, can you just let me know in a Q&A? Does that make sense? Do you have any additional questions on a market order? Folks, I do see some of the other questions coming through here as well about after hours trading and limit orders. So we're going to get there in just a second. No problems. But I see a couple of thumbs up emojis coming through. So Pierre, I think we're good to go. Do you want to talk to us a little bit about a limit order and why that might be, or how, not why, but how it's different than a market order? What are some of the considerations?
Yeah, absolutely. Let's dive into that as far as the, I guess, concept of market order, limit order over my years. That was a extremely common question. Which one is best, and what that really boils down to is, well, it's best based off what it is you're trying to accomplish. Now, like you just walked us through, Chase, if you are trying to get a fill, you're trying to get a fill pretty much right here and now. Yeah, you want to get a reasonable price. That's perfectly fair. But next available price with something that's not too thinly traded, has some liquidity behind it, should not be any issue whatsoever. Like you had just described, market order will probably fit the mold for you. If you've got a order that you are maybe on the fence about placing, or it's something that you want to place, but there is a predetermined value that you have in your mind, that is more times than not when maybe a limit order is going to be better for you. And the reason is that you actually, with the limit order, get to designate the price that, as a seller, you are willing to receive. You can say, hey, I've got a handful of shares of stock. It's trading at about $100, clean round number. If it gets up to 105, I'm okay to sell those shares, but don't fill this order unless I can get that $105 per share or better. And the reason that I say that or better is that you do have the ability, of course, with that limit order. Well, maybe there's something that takes place day over day that could make that stock price go even higher than the 105 in my example. We'll get to what are referred to as gaps. I know there was actually a couple questions that discuss that. But back to at least the limit order itself, the way that I always try to give the, I guess, differences between market and limit order is you both have a couple guarantees. A market order is guaranteeing that you're going to get that fill. You just don't know the exact price. A limit order, quite the opposite. You are guaranteeing the price that you are either going to be paying as a buyer or receiving as a seller. You just don't have the guarantee that it's going to get filled. And the reason being, just like you're pulling up here now on Active Trader Pro, you beat me to it. I was just about to do that as well. Reason being is that who knows if the price is going to be reached or not. I'll give my own example here, Chase, to save you the trouble. I've got this more or less just side by side in Active Trader Pro. So as we had discussed with the market order, I've got a symbol that did have a little bit of that gapping risk, which we'll talk about in a few minutes. But do focus your eyes over here towards the left-hand side of the screen. I've got Salesforce pulled up. If you're out there trying to sell market, well, like Chase said, it's just the next available price. It's right here and now. Whereas if you actually are selecting rather than market limit, what you're going to notice is you actually get dynamically an additional field that you're able to go ahead and put in. This would be that example where, you know what, I want to sell these shares, but only if I can get 215 or better, or 220 or better. Now, you have the ability to place that as a day order, meaning go ahead and try to get this filled by the end of standard market hours. And if not, cancel it. Let me reevaluate overnight, go back to the drawing board tomorrow. You can also do other order types, good till canceled. On that slide, what that was going to go ahead and refer to or show is that you do have the ability to place these orders for, it's about 6 months, I think 180 days out in the future. And in your mind, or why that might fit is, hey, I'm okay selling this share at 220, and I don't really care if it happens today, tomorrow, month from now, 2 months from now, whatever that standpoint's going to be. Once again, those good till cancel orders are valid out for 180 calendar days there in the future. Now, those are just a couple of the subtle differences. The only other thing that I'd like to add to the story with a limit order is this, especially since the topic of the day that we're going to transition into our stop orders, risk management. Sometimes I've heard clients say, okay, well, what if it's trading where it is now, but if it goes down to 210, I want to sell it. Here is the difference, folks. If you have a sell order at a price, given your limit, that is less than what it's trading at now, go back to that terminology I used. A limit order says I, as the seller, am willing to receive $210 per share or better. And if it's trading at 213.85 and you hit preview place, the system's going to say, okay, well, you said you're willing to receive 210 or better. I guess it's this or better. Let's go ahead and fill you right here and now. That's one differentiation I like to give. Market order, kind of placing it, guarantee is it's going to get filled and you're looking for it to get filled, hopefully right around this price tag. Limit order, you have the guarantee that you are going to get the price that you're putting in or better, but no guarantee it's going to get filled. And then do keep in mind, if you have a limit order that is below the market, that's what starts to transition into, okay, you're probably doing this because you're thinking about, actually trying to maybe mitigate some losses or protect some profits, which is when these next order types like stop, stop limit, and then trailing stops actually begin to enter into the conversation. But I know we certainly wanted to at least review market limit because, as you can imagine, stops and stop limits are actually going to build on these couple different concepts that we talked about so far. Jace, let me iron out, since I do have Active Trader Pro pulled up for just a moment. What I'll do is a quick answer or two of a couple of these questions. We'll go through with stops, and then towards the end, we can give a more robust answer. Few questions that did come through about being able to trade after hours. And if you are looking to do that, folks, the order ticket through Active Trader Pro you would do that on is going to be the directed trade and extended hours. There are still some earnings coming through. It's maybe not the behemoths, kind of in the Magnificent Seven. NVIDIA was just these past couple weeks, but there are still a number of other earnings that are coming through. If you were looking to place an extended hours trade, the directed trade and extended hours trade ticket is how that is done. This gives you the ability to buy, sell. Everything's going to be really synonymous with that same trade ticket that we had before, with a couple other differences about being able to actually route this somewhere in particular, and also being able to have those orders span from the pre-market to standard day trading sessions to the after hour sessions as well. We can get into some of those order types a little bit later. Let's go ahead and table that maybe for the time being, but I just quickly at least wanted to go ahead and show that trade ticket. Once again, that is the directed trade and extended hours trade ticket, which shows you kind of the depth of book, as it's called, a streaming time and sales environment, as well as the ability to go ahead and place these trades after hours. Chase, you want to tie a bow on that as far as market versus limit, or should I go ahead and actually begin to foray into stop orders as well?
Yeah, let me hit one question that's related to it, Peter, and then definitely feel free to hit the stops after. So Kim was just clarifying, can you create a limit order um, that also trades during after hours? So just to clarify what you were saying there, Peter, is you can place what's called a day plus order. I know that's a little bit advanced, but technically speaking, a day plus order is eligible to be executed both in the extended hours, so pre-market, and in a standard session, which is 9:30 a.m. to 4 p.m. Eastern time, and also the extended hours after hours, which is from 4 to 8 p.m. It's called day plus for the time in force. If you don't mark it as day plus, and this kind of gets to um, Ada's question, let's say you have a good till canceled order, which is different than time in force day plus. If the stock doesn't meet your criteria during the standard session, but then it does during the extended hours, would that execute? It would not, because the good till canceled order, while it's good on file for 180 days or until filled or until canceled, that's only for the standard session window. So I guess the way I would answer some of these other questions about extended hours is like if you want to trade in extended hours, especially through ATP, the order has to be placed through that extended hours trade ticket or the version of the ticket. If it's not, then you're likely going to be just trading in the standard session. So just kind of keep that in mind for sure. And then just real quickly on the limit, we had a question that came through from ME saying, I keep getting different answers on this question. And the question follows, if you put a buy in for $100 limit order, are you guaranteed you won't pay more than $100? Yes. You're just not guaranteed an execution. However, if the stock gets to $100 even or lower, then we will fill you at that next available price with that price parameter. But I mean, if you place an order, let's say a buy limit order for $100 on Apple, Google, whatever, you're not going to see us fill you at like 101 or 150 cents, $100.50. That's not going to happen. It's, hey, we're going to fill you if we can get it, if it's out in the market at $100 exactly or cheaper. So you're guaranteed a fill if those conditions are met at 100 or lower, but you're really not guaranteed a fill itself. That's kind of the difference between market versus limit. Okay, awesome. Yeah, and, if you want to take it over from there, Peter, hop into maybe stop orders and how we compound on the concepts of market and limit.
Yeah, no, happy to go ahead and do that. And let me transition back over to the slide for just a moment or two, and then I'll try to continue kind of this demo. I said that market and limit are kind of building on the concepts that we're going to talk about next for stop loss, or what's synonymous with, where we go, with stop or stop limit. So let me go ahead and flash that slide for just a moment. We'll talk about some of, once again, common questions I've had when describing these. So we have a stop loss or stop limit. This does get into the realm of stop orders in general. And both of them here with these bullet points are very, very similar. Maybe just a word or two, honestly, is different. So let's talk about some of those similarities. What you're seeing here, generally used to protect profits or prevent further losses. It's going to be the same in both of these cases and scenarios. And I would take it even maybe a step further. The reason that you would have stop orders is because you're perhaps trying to take some of that, mental fatigue off of your plate. You're maybe letting the system or the order types do some of the heavy lifting, or maybe you've already come to a conclusion that says, you know what, I'm looking for opportunities, but if the stock begins to break down, maybe my trade thesis is invalidated. Perhaps the directional thought process I had for where the stock is going is getting invalidated. And these types of orders do give you the ability to take some of that burden off of your shoulders, especially if you're trading a number of different securities, the volatility that we've seen these days, and even from the standpoint of, I have been guilty of this before. You don't have to raise your hands out there, but maybe you feel the same way where you said, you know what, let's go back to kind of the example. I'm maybe buying a stock at $105. And I'm hoping for profits. I'm thinking this thing's going up to 120. But then what happens? Well, wouldn't you know, it trades down to 103 and 102, 101. And I tell myself, okay, if it gets to 100, I probably need to go ahead and close. Let's sell it and then think about it again. But then what happens? Maybe it gets down to 99, 98, 96. And what do? Do I sell it? Do I act on my actual mental stop in my mind? Do I act on that management process? I maybe did not in the past, at least. I can say I'm still argue with my mind sometimes here and now. But the point is, if you're able to go ahead and set that line in the sand ahead of time, whether it's an arbitrary number that you have, whether it's value that you see based off fundamental work that you've done, maybe there's some technicals or indicators that you're following that say, hey, this is maybe an area or a zone where if it starts to break this, I got to close and reevaluate. Sometimes in the heat of the moment, it's hard to actually take action on that. Whereas these orders are going to go ahead and give you that ability to do it without you actually having to command it itself. Now, let's talk about some of these differences. Difference that I say between these stop orders is this. I always say stop orders both have trigger prices and they both have a trigger or some type of signal. Now, when that trigger gets met with a stop loss, it turns into a market order. When a stop limit gets triggered, it turns into a limit order. So go back to what we just talked about. If you have an order that turns into a market order, what's going to happen? Well, it's designed to go head off at that next available price right then and there. So we're using this as far as stop orders from the standpoint of a long portfolio that's looking to sell shares. You can use these orders for entering into positions, but we're going to think about it from the, as we talked about in these first bullet points, protecting profits or preventing further losses. So think about the check marks, okay? Stop loss, it gets triggered, turns into a market order to sell at that next available price. With a stop limit, it gets triggered, turns into a limit order. And what did we just learn about limit orders? Well, it's then going to turn into a limit order to sell at your limit price or better. And that's why that third bullet point, what I had talked about, where those guarantees come into play, is so important. It ensures here with a stop loss that you're going to get an execution, but you don't know the price because it's going to be the next available price. You're not designating that price. Whereas if you want the privilege to go ahead and designate the limit price in mind when triggered, well, you're going to then be able to go ahead and guarantee the price that you are receiving as the seller, but maybe that execution is not going to occur. And that's why I wanted to transition over to Salesforce. There's a number of different examples out there. This is one that's been talked about quite a bit here, folks, and dovetails into questions that were asked about what is referred to as a gap. And that's kind of what we're seeing here on the page. If you are unfamiliar with a gap, folks, what that means is price at some point in time, usually overnight, had changed drastically. And I can kind of zero in on this, but we closed yesterday roughly at about 270 or so. And then this morning opened up at 220, 225. It's about $50 difference. A lot changed. I'll talk about gapping risk in just a moment, but be mindful of these orders. So let's go ahead and start to transition these. Sell, that's going to be the same. We're still looking to sell the shares. A stop is what's going to go ahead and turn into that market, and a stop limit, well, that's going to go ahead and turn into that limit order. So here in my example, let's say that you wanted your stop to be 260. What that means, synonymous back with that stop loss we talked about, is if the price, let's zoom in maybe just to 3 months. If the price here is actually working around, pinging around as a bull. You're hoping that it goes higher, but in your mind, if it gets below, let's say 260, just a round ballpark number, that's when you want to go ahead and sell your shares. Well, if that stock just happened over the course of maybe the day or the next day and just kind of meandered around down to 266, 265, 260, well, the very moment that that last price hits 260, this is then going to convert into a market order to sell at that price or better. Well, if it turns into a market order throughout the day, when it gets down to 260, it's a pretty high chance that it's going to be trading around 260 because momentarily that's at least where pricing was. The risk comes into play if you have these orders not just good for the day, not just good for the standard day trading sessions, but good till canceled, because that is when these orders will actually bridge from one day to the next, like we mentioned, out 180 days in the future. So there very well could have been folks out there with a stop order at 260, just like we talked about, thinking that, well, if it opens up below, well, my risk parameters are going to be in play. Go ahead and get me out. However, what do we see with this gap? It actually opened up down here at this roughly 220s price tag or so. If you had a stop loss order, even though your trigger was set at 260, given this gap that took place, rather than getting out roughly at 260 kind of in your mind, where you wanted to go ahead and maybe be a seller, well, that gap actually took you all the way down to roughly 220, 222, whatever that price was. You're then going to be getting out at that next available price down here at a price far kind of below maybe what your expectations were. So a stop limit comes into play because let's keep these same parameters. Let's say 260, but in your mind, you want to make sure you get 260 for your share, saying, go ahead and ring the bell, sound the alarm. If we get to 260, that's when I want you to trigger the order to sell at 260 or better. And I've seen this iteration. What's the difference between these two order types? Well, with the stop, you got out there pretty much right when the stock opened down at about 222. And maybe folks that had a 260 stop are kicking themselves because they're thinking, gosh, I got out far less than I expected. If you had a stop limit wanting to receive 260 or better, you're still holding those shares. And rather than getting out at that 222 or so, now it's trading actually even lower down at about 214. Now, could this have been the exact opposite? Could this price have opened up at 222 and then actually climbed all the way back to 260? It's possible. Is it probable? Who really knows? That's not really what we are here to discuss. Do recognize that these types of orders have their benefits, they have their drawbacks. And if you're going to be using them on this good till canceled basis, one of the biggest, I suppose, drawbacks or risks is kind of this overnight gapping risk where potentially a price is going to be far and above or far below, I should say, the price that you were maybe expecting. Now, I've seen some variations of this, Chase. I'll welcome some of your thoughts on stop orders as well. I've seen some folks that'll put a kind of what's referred to as an aggressive limit, saying, okay, well, if it gets down to 260, go ahead and get me out at 257 or better, something of that nature. Even though it's a few bucks down, I just want to make sure that even if this took place throughout the day, that if it was to drift to 260 and then immediately go down to 259.95, 259.90, well, I don't want to quibble over a nickel or a dime or a quarter or even a couple bucks. If it's getting past a certain level that I have in my mind, that's because that is where my risk management needs to kick into play. Even if I have to maybe miss out on a few dollars worth, it's better for me to go ahead and get out and reassess that situation moving forward. Now, let me take a pause for a moment. Once again, Chase, I welcome your thoughts. Let me also go ahead and look at some of these questions here. Mark was asking why/when is a stop limit not executed if it reaches that stop price? Make sure I'm reading this correctly, Chase here. I would say, when would it not be executed if it reaches that stop price? Well, if this was to get to 260, then it would convert into the limit, whatever price tag you have it designated at, let's just say 259. When might this type of order not get executed? Well, kind of in the situation like we're seeing now. Think about this. If you just had a regular limit order to sell at 259, well, price is at 214. Everybody would love to get 259 for this, but the price is below your limit. So I would use the language here, Mark. This scenario for this trade here with our stop limit, a stop limit, which is the trigger at 260 with a limit price at 259, this order in your orders would show triggered, and then it would show a open limit order to sell at 259 or better. So the language I would coach to would be, this order, given this outcome or scenario, would be triggered because it breached the 260 stop that you gave it. However, it would still be open given the fact that it's trading below, in this case, your 259 limit. Chase, do you read that question any differently, or is that kind of on par with how you would be thinking about it too?
That's how I read it. Yep.
Okay.
Yep.
And
The way I'd answer it as well, sorry, Peter.
no,
Maybe a
go.
different way you can think about that too is it's more of like an if then statement, right? That stop limit. So if my initial criteria is met, the 260 bucks that you have in your example, then place this limit order, right? It's kind of an if then statement. So really both conditions would have to be met to have a successful total execution of the trade. But yeah, in this case, if it gaps down, it's kind of like, again, it comes back to the question of what are you prioritizing? So we take a step back. A market order prioritizes a guaranteed execution. Like, hey, trade it right away. I don't care about price necessarily. Just get it done, right? Then you have a limit, which is like, hey, I can't really guarantee execution, but I want a certain price. And as long as I can get a price there, good to go. So each one kind of has its own benefit. A stop order is like, hey, I want some kind of risk management. If this initial trigger is met, just get me out. I don't want to get too picky with price. Just get me out, right? I'm done with it. That's kind of like the mindset, right? From a risk management perspective. And really that's the whole goal. It's like, hey, if something like CRM, Salesforce, or any other company starts to, let's say turn bearish when you have a bullish or long position, the stop is just like, hey, just get me out, man. I'm done, right? Move on to the next one. Let me get my capital out of this thing and try to find something else. Where the stop limit gets a little bit more picky. It's like, well, I want my cake and I want to eat it too. Like, hey, as soon as this initial trigger is met, then I also want to set this other price condition, and that better be met too. But if it's not met, you're still in a position. In my experience, and this is anecdotal, Peter, but I mean, I've probably spoken on the phone more than 10, probably 20,000 clients in the years I've been here cumulatively. I've seen a lot more clients be unhappy with a stop limit, mostly because they didn't understand that both criteria had to be met. Like, hey, the stock went down. They thought it was going to sell it, but they didn't realize that that second condition, the limit portion of the stop limit, wasn't met. So they stayed in the position, and then it continued to go lower and lower. And the whole time they're kind of like, hey, what's going on? What's going on? They call Fidelity. Hey, you folks messed up. Unfortunately, we didn't. That was the order type that you submitted, and the conditions weren't met. So, yeah, if you're new to these orders, which I would assume if you're in this kind of session, more often than not, a newer trader trying to utilize these orders would probably stick to a stop order to start, to just say, hey, if my initial criteria is met, just get me out. I don't want to play games. And as you become more sophisticated, that's when you might add that additional criteria.
Yeah.
So just a thought there.
The other thing I'd add to that is that's why we also always encourage to try to be mindful of any type of binary event. Clearly any type of gap can take place even outside of an earnings announcement. It could be macro data, could be industry specific, sector specific, could just be something that nobody really knows. The price just moved. But these orders we've talked about on the day and then also good till canceled basis. They also can be used by intraday traders or day traders themselves, and that is where is it possible for a price to move a tremendous amount in short order throughout the day? Yeah, absolutely. But the gap here, happened kind of overnight. You wouldn't really observe in normal markets unless there's something fast moving or a halt. You wouldn't really observe that there's going to be much of a gap or a break here, at least when it comes in terms of a $200 stock. You wouldn't expect it to be trading at 224 and then the next tick is at 218 and the next tick is at 215. Oftentimes there's going to be much more liquidity there. A couple
Hey,
ironed out
Peter,
questions. Go ahead. Go ahead.
sorry, real quickly. Yeah, thank you. Can you actually go to a screen that has the extended hours? Sorry,
Yeah,
I
that's
just saw you click on the tab there.
go ahead.
I
Go
just
ahead.
wanted to call it out because we had a question from Pat C, who said, did the gap occur during after hours trading? Yeah, it absolutely did. In fact, that's kind of really how that happens most of the time. Like, can you have a gap intraday? I've seen it, but it's pretty uncommon. The number one thing that I see through time that moves companies in a significant manner that forms gaps on their charts is a fundamental news event like the FOMC announcement, which is midday sometimes, or most of the time with the commentary from Powell. So that could be midday, but really like an earnings announcement. And those are going to happen before the market opens or after. So that's kind of where that gap is occurring, is because price is moving outside of those normal hours. If you go to the settings button, if you can just walk us through this real quick, Peter, on ATP, if you click settings, you'll get a checkbox down in the left bottom corner that says show extended hours. As long as you're on like a non-daily or weekly time frame, so like 5 minutes, 3 minutes, 1 minute, 60 minutes, 30 minutes, you can toggle this on to see what's going on there. And then the second question that came through real quickly, Peter, while I'm answering some of these, is can we place a stop loss that is day plus? The answer is no. And the reason for that is because the stop or the day plus condition means it has to be eligible to be executed either pre-market or aftermarket. So limits, yes. But if we change that to, let's say, a traditional stop or stop loss, the day plus is not a choice in time and force. So a stop loss can help manage risk, but it's only going to manage risk from session to session, standard session to standard session. If you do have that gap, that's why we point out these order types and some of the limitations behind them is they can't really protect you against those significant gap risks that may occur. Now, could it help you in that with CRM? Let's say it opened up at like what, 226 or something on a chart, and you had a 260 stop, would sell you right away if you had just a normal stop loss at market. You probably get filled around 226, and the stock's down even further. So while it didn't save you from the gap itself, it has saved you from the intraday sell off, then further from today's open. So, there's some give and a take. There's no perfect kind of potion there.
Let's, I think what goes back to what you had said before, if you've identified some type of level, and 260 folks was just arbitrary here. Some clients might have had it at 265. Maybe you incorporate other types of technical analysis like a moving average or a trend line, whatever that might be. But like Chase mentioned, the reason that you want to take some of that mental burden off of you having to determine, okay, well, 260 is just a level that I've identified. If I'm below that, my trade thesis is invalidated. I got to get out. I got to manage risk. I got to take my lumps and look for different opportunities, which is really some of those conversations I've had with clients over the years where they'll say, well, now it's so far below, what do I do? Do I stick around? And I ask them, well, what was your plan? Well, my plan was if it was under 260 to get out. And now you're thinking, okay, well, we're under 260. You said you wanted to get out. You had this kind of stop limit situation going on. Are you still holding it because now you feel like this is overdone? Do you think there's going to be some type of temporary bounce? And that's when you start to get into the coulda, woulda, shouldas, what if happens, this, that, the other. Lots of this is to be able to take out lots of that mental angst and say, here's a level. I got to go ahead and stick to it type thing. Tara was asking Terrell or Terrell. I've got two friends that go by different versions of that name. Hopefully, I'm getting close there. Prices adjust for dividends or X dates. That is what these conditions are for. None is the typical, and then do not reduce. Do not reduce is the reference there to dividends. If you are looking to make those considerations, like Chase had mentioned, the more that we start to pack onto an order, stop limit with the limit, good till canceled, all or none, do not reduce this or that. That's going to start to add more and more conditions to the trade ticket, to our order. It's going to make it just a little bit harder to get filled. Mark was asking, can you go ahead and change a stop to a stop limit? Mark, you can, as long as your orders are, still intact or still open, I should say, or even if it's been triggered but has not filled, it's still open. You certainly can go ahead and cancel and replace any type of order that you would like. Under settings on the orders window, there is actually different fields that you can have added for what we're going to talk about in just a moment, like the conditions, like these trailing values, like what the trailing amount is. That kind of gets into some of those stops themselves, and the order types as well. And we'll talk about those in just a moment, but most certainly you can go ahead and change orders so long as they are still open. If an order has been filled, hard to go back to the marketplace and say, oops, I didn't really want to do that. But you do have the ability, so long as they're open, to go ahead and change the type that you are looking for. Only other thing that I would add to this, and then let's go ahead and carry on the conversation, Chase, if you're okay with that, was going to be that the Kim asking about cost or fee for after hours trading, and really it's going to be the same. So as long as these are, I try to think about the exact disclosure that we used to say, online, domestic, equities, this, that, the other, they're going to be that commission-free charge that you're looking towards. And there's not going to be an extra charge or surplus or anything like that for an after hours trade ticket versus the standard daytime trading session ticket that we are going for. Kelly asking a great question here. We're going to get to that one, Kelly. Stay with us because that really hits it on the nose that we're going to talk about right here and now. But Chase, go ahead. I think I had shown that 260 line in the sand. You could try to visualize what that stock had kind of done after the fact. Stop orders are, as I had said, one that you kind of set and forget. It's going to be stagnant. You can, of course, go ahead and modify that order. You can cancel and replace if the stock is moving up in your favor. Maybe you want that stop order to go up from 260 up to 265, up to 270. Go ahead and protect some of those profits. You can certainly go ahead and do that manually, but that is part of what these trailing stop orders are trying to solve. So why don't you go ahead and break those down for us?
Awesome. Yeah, Peter, you read my mind there. I was looking at Kelly's question too. Perfect segue into a trailing stop loss. So, just for the benefit of the group, Kelly was asking if you own a great stock. Now, she had mentioned Microsoft, so we could even switch from NVIDIA to Microsoft, no problem. Should you set a stop loss or should you just ride the dips? Is it better to set a stop loss to let it go lower? Should you buy after the fall? How do you know where the bottom is? So, yeah, a lot of great considerations I think any reasonable trader and investor might ask of themselves. So one of the ways that a client might use a tool to tactically address this is a trailing stop loss, which is just a way to say, hey, I want to initially set a stop loss. Everything we've talked about, right? Nothing's changing just yet. I put a line in the sand. If the stock goes beneath it, sell it. But as the stock increases in price, I will then want it to adjust by some kind of offset and trail it. The analogy that was once told to me when I was in training years ago was imagine almost like a ball and chain around your ankle, right? If you slide your foot forward, the slack in the chain kind of becomes taut and then you drag that ball behind you, if you will, right? And so you can kind of imagine that as the stock goes higher, it drags the order up with it. But if you were to kind of retrace your leg back, the slack in the chain becomes just that slack again. And so the ball doesn't quite move. So these orders only adjust when the stock price increases. They maintain that same level. If the stock even goes down a little bit, goes sideways, it will never adjust downwards. That's the main thing. So think about it as a typical stop loss, which is everything we talked about up to this point, that only adjusts upwards if the stock goes higher. That's a trailing stop loss. These are very commonly used by, let's say, longer term investors or long term investors who also kind of have that trading mindset of, I want to tactically manage risk. I don't want to just hold it forever and look at it once a year. If the stock, reverses by 50%, I don't want to be a part of that, but I want to give it some breathing room and have some kind of form of risk management. Now you can set this trailing stop by either a percentage or a price amount. So let's use an example real quick. Kelly, you had mentioned Microsoft, so we'll go to ATP. Here's a longer term chart of Microsoft. And again, I'm kind of picking on a longer term chart because that's more often how these orders are applied or used. Could you use them in a shorter term? You could, but that's kind of where their benefit is derived from, is the more intermediate term. So we go ahead and we pull up a trade ticket. Again, we can use Microsoft, no problem whatsoever. Let's say we want to sell. So this is a sell trailing stop loss, 100 shares, order type, trailing stop loss as a dollar amount or as a percentage. So if we do a dollar amount, what we're trying to say here, we'll just use a really simple example of $10. Okay. What we're trying to say is at Microsoft being 417 bucks, we want our stop loss to be right now at the time we place it, $10 lower than Microsoft. And we could even make round numbers just because of where its current price is. If the price is at 417 and change, if we set the trail amount to $17, then the immediate order would be placed around $400 per share. And as the stock goes up, it's going to adjust from 400 to 401, 402, 403 as the stock increases. But if it pulls back, it's going to stay put where it is. Okay. You can also change this to be a percentage. So, hey, I want it to be 10% away from current price. Now, why might you choose a percent over a dollar figure? Well, $10 a share on Microsoft back when it was $200, kind of meaningful in a way, but less so when it's a $400 stock, right? But a percentage is always going to be, what's what I'm looking for, like commensurate or sort of in relation to the overall stock price. So it's going to be able to say, hey, 10% when it's 200 is a certain number, 10% when it's 400 is a certain number away. And it's always going to right size itself, if you will, from a percentage perspective. But you could choose either one. The idea here being is you want to give yourself some room. So as this continues and it has those little bit of pullbacks, you can kind of give yourself some leeway. It's not a perfect analogy, but I like to show this real quick, Peter. I think you're with me the other day when we talked about this. There's an indicator. It's really meant to be used as a trading system, the parabolic stop and reverse. But the idea here is it's just a really good visual aid of explaining kind of what a trailing stop loss does. So if we just zoom in for a moment and we take a look at this section right here, let's assume our trailing stop loss was placed here. Now remember, this is an exponential factor, so it's not quite one-to-one, folks. It's more of an analogy than anything. But the idea is as the stock goes up, our trailing stop loss would adjust upwards with the stock, never adjusting downwards. So that if the stock retraces, it has a throwback, it coils or it tucks in, whatever you want to call it, rolls over. Once it then crosses that threshold, well, now you don't have to hold it as it retraces all the way down. You're going to get sold out somewhere up here, as an example. Again, this is a very specific indicator with a specific purpose. It's not quite one-to-one to what we're talking about, but it's a good enough, I think, visual aid for most people. So yeah, Kelly, to your question, if you had something like Microsoft, you might just say, hey, I want a trailing stop loss. And maybe I'll set it to be like 10% away or 10, 15%, 5%. What are some ways we could maybe think about this? Not to get too advanced, but there are some indicators like average true range percentage, for example. Average true range percentage, Peter, is going to tell us on average, based on the past 14 trading days, if you're on a daily time frame, how much does this thing move up or down? Well, right now it's about 1.7% per day. So is a 2% trailing stop loss kind of close? Well, it's about 2 days, almost 1 day's worth of movement. That doesn't really give you a ton of wiggle room, right? How about 30%? Well, 30% is probably a lot relative to this stock, right? So you kind of have to think about that, but this is an indicator that will give you a visual aid. What's nice about the percentage is you can use that on whatever company, and it's not going to be like price dependent per se. It's always going to look at the percentages here. So Nvidia, for example, is at 3.62%. So about twice what Microsoft is in terms of its realized volatility, if you will, daily. So you might look at that and say, hey, if Nvidia moves 3, 4, 5% per day, if I have a trailing stop loss that's only 5% away, by tomorrow I might be able to get stopped out. Maybe that's good. Maybe you want that tighter risk management on something like Nvidia. But if it continues to rally, then the order would update with it. All right, Peter, I'll stop there. Anything that you want to add to a trailing stop loss, how it's used, how it maybe adds that additional layer to a normal stop loss considerations traders should keep in mind?
I think the big part is what you were mentioning there about using the percentages versus dollar amounts. Sometimes that's going to be a preference. My mind usually is thinking about things. The term I always use, Chase, is kind of putting it in relative terms. So that unit measurement that you're using is a kind of on even keel. And I mean that's exactly the same reason that we look at AT goodness gracious, ATRP versus ATR is because able to go ahead and put it in those percentage terms rather than looking at a stock like Microsoft trading at 400. Well, its average true range in nominal or dollar terms, could be vastly different than looking at, Salesforce. And even Salesforce itself, dropping, percentage wise what it did, maybe its average true range is still pretty wide. But given now that that price is coming down 20 some percent, could throw off those metrics. So usually we're taking a look at indicators that are in those percentage terms. Trail amounts, I think, are a great thing to do. We get the question so often about, well, what's a good percentage? And that's another reason that I think looking at that average true range percent and then using perhaps some type of multiple of it, like you were discussing, or maybe that in tandem with a trend line, concepts of support and resistance go a long way versus just saying, okay, well, I'm going to always have you name the percent, 5, 6, 7, 8, 10% stop loss. 10% move for some stocks these days might be very commonplace. If you're seeing a 10% move in something that only moves a percent per day, okay, that's probably going to be sounding the alarm, which is why oftentimes these orders are fantastic to be able to take the mental strain out, give some type of framework to your positions, and then also kind of that golden rule of using stops and using trails. Folks, usually if you're using those trails, it's because what? They are one directional. They're moving in your favor. That goes back to what I said I was guilty of towards the beginning of our session. Sometimes I would creep that, stop down a little bit. Maybe like I mentioned, I had 100 and I know I should get out, but it's at 99. Maybe it'll come back and you move it down. You move it down. You're kind of giving it that longer leash. That is why, once again, these orders are designed to go in one direction, is to go ahead and take part in that move, hoping you're capturing the trend. But then when that trend begins to show signs of bending or ending, as it's called, that's when you need to go ahead and protect those profits that you got, look for other opportunities, reserving the right to go ahead and get back into positions if you see fit or would like to. But oftentimes it's kind of that prove it moment for stocks. Chase, there was a question. I know we got a little bit more to cover. Mainly, we're getting towards the end of really that slide deck. I think
Yeah,
you're probably queuing up that question maybe about Annie, about being able to use this maybe in a buy scenario versus
correct.
a sale scenario. So I don't want to step on your toes if that's what you're going to, but if not, Annie will definitely cover that question, either Chase or myself. But
Yep.
Chase, go ahead.
You read my mind again, Peter. So that's exactly where I was going to go with this. So everything we've talked about up to this point is really from a risk management perspective if you're already in a position. Now, that's what we really care about here on a trading strategy desk because we want to preserve your capital or help you to help yourself to preserve your capital. A missed opportunity, that's opportunity cost, but that's not real money lost. However, you can use some of these orders to get into a position. So, for example, someone might look at a company, let's just say NVIDIA or a technical setup. This is more of a technical analysis kind of thing. But you might say, hey, here's some significant resistance. And if I get a break above this, I kind of want to get in because there might be some meaningful trend change, right? We can see that we had this movement up a little bit higher with prices, almost like a triangle squeezing into this level. If it breaks above it, I want to be a part of the ride. So can you do that? You absolutely can. So if we take NVIDIA, in this case, the action is going to be a buy if you wanted to. And the order type, for example, is a stop. So everything that we set up to this point is still true. It's just now we're buying as opposed to selling. What do I mean by that? Well, if I said, hey, I want to buy at $1,000 even, that's again my trigger price. So if price gets above 1,000, this will trigger a market order to buy NVIDIA at whatever the next available price is. If we had that set up, looking at this candle right here, it opened up because of the gap at, let's see, the O was $1,020.28. So this open, and the way I'm finding that is up in this top left corner of this chart where it says O. If I hover my mouse over the candle, it tells us. So if I said, hey, I want to buy stop. Again, the stop is just a trigger. I want to buy if the stock gets above $1,000 at market. Would that have triggered and executed in this case? It would have, right? We would have bought at about $1,000 and 1,020 probably, 1,030, depending on how fast things are moving. Then we'd be in a position, now we own shares. And then from there, we could place a sell stop loss to manage risk. We could place a trailing stop loss if we wanted to. We could set an alert. I saw a comment from somebody. And by the way, folks, this has been an awesome and a very interactive group. We got tons of questions in here. So I apologize if I can't remember the name, but someone was saying, hey, could we just set an alert as opposed to a trailing stop loss or some kind of risk order? Yeah, of course. You could set a price alert. And this is almost like a mental stop, right? Where you're saying, hey, if NVIDIA gets to a certain price movement, let's say it falls or rises, excuse me, above 1,000, then send me an alert so I can then manually go in and take a look and see if I want to buy it. You could do that too. But this is more of like a trading system where you're trying to automate that entry. So yes, you can do a buy stop. A stop limit would be the same as a sell stop limit. We're just buying. So you have your initial trigger, then you have that secondary condition that then also has to be met. So let's say we put the numbers as the same. The trigger's $1,000. If NVIDIA crosses 1,000, then we're going to submit a buy limit for $1,000, which means the stock has to be below 1,000 to get executed. Would this have gone through fully? It would not. It would trigger the first part. We'd get this order ready, but this wouldn't execute because NVIDIA's only gone up since then, right? Okay. Another question I saw here, Peter, and at this point, I'll be honest, folks, the core content I wanted to cover is basically covered here at this point, Peter, unless there's something else you want to add. There's tons of questions. We got plenty, 20 plus questions. So I want to do our very best to kind of get through as many of these as possible. There's a question about, could we place these orders from a risk management perspective at the same time we enter? And you absolutely can. My favorite way to do this, very, very easy. We have a tool called Trade Armor, which is underneath trade and orders. Now, I will admit there's a bunch of different ways to do this. This is just, in my opinion, the best or fastest or most efficient way to do it. We can pick on NVIDIA or whatever other symbol we want, no problem. Once we type it in, we click trade. Okay, right here. We'll keep it on stock. And this action button, I like this because if I click this, for example, a buy triggers bracket, OTOCO, one triggers one, cancels the other. Say that 5 times fast, right? What this will let you do is place a buy order, let's say a market. So, hey, I want that immediate execution. And as soon as it fills, then place a bracket or a price parameters for a profit-taking upper sell limit and a lower stop loss to do just that, stop my losses. And what's cool about this tool is as I adjust these orders, I can left click on these blue boxes and slide this. I can also just manually type in and change these boxes. It does the math for us of like what our estimated gain or loss would be based upon execution of the prices that we've dictated. So this is a really easy one-stop shop to say, hey, I want to enter a trade. And as soon as I do, I want to have all my knowns in place. I want to have a maximum loss determined and a maximum gain determined, preview and place the order. And then those two orders, that bracket, if you will, you can set for time and force as day. But much more commonly, Peter, as I'm sure you've seen too, people set these as good till canceled. So you can set this kind of set it and forget it for 180 days at least. And as the stock kind of ping pongs or moves between these prices, whichever one gets executed first is the one that goes first. So if this continues higher, it's going to hit our sell limit for our profit. If it goes lower, it's going to hit our stop loss. We're going to lose some money, yes, but we're going to manage our risk. We're only going to lose 3 or 4%, right? And then we can think about this tool of like, well, hey, what's tenable? What's reasonable? Maybe I want a 2-to-1 ratio of reward to risk, right? So you can kind of start playing with this. But in my experience, this is probably the easiest way for a trader to do this. And I do encourage people when they first start, if you're trading, even if you're trading small, that having these kind of orders in place when you start is a pretty good way to keep yourself honest. Technically, you could change them after the fact. There's no problem. If you were to place this, it executes. You could then, after the fact, change these two orders. But the idea is you want to keep them in place to some degree to help manage risk. One other thing I'll just note real quickly, Peter, I know I'm taking up basically right to time, but I think this is important, even for beginners, is let's say you have a position, like we'll go back to Microsoft, and we can see here that we had this bounce, we got to this peak, and now it's starting to reverse off of that all-time high, and you get a little bit nervous. Well, let's say you have 100 shares of Microsoft. Do you have to place a stop loss on all 100 shares? You don't, do you? Right? So just like people dollar cost average, or they kind of buy little bits and pieces through time to accumulate, you can do the same thing for selling. So there are some instances where you might say, hey, listen, I don't want a really tight stop loss on all my shares, but maybe if I only have half my shares, let's say 50 of the 100 I have in this example, I'll set a relatively pretty tight stop loss so that if this doesn't reverse immediately, I'll at least sell half my position. And then I'll hold this other half, maybe wait and see if it comes down into this trend line and then bounce from there. If it doesn't bounce from here, maybe I'll put a stop loss just underneath this line at, let's say, $400 per share, right? And if it gets lower than that, then I'll sell my remaining half, but I got rid of my first half at this higher price. So I always like to clarify for clients, risk management is the most important. So do most clients set a stop loss for their total quantity of shares? Yes. But if you have a specific or strategic technical plan, if you can be trusted with your own responsibility and due diligence, which is tough. I'm not judging in any way. Trust me, it's tough as a trader, right? You place a trade, you have a plan, then you change your mind halfway through. You kind of have that internal monologue with yourself. But as long as you're disciplined, you could say, hey, rather than sell all my position, maybe I just sell half or a quarter of it. And I'll layer a bunch of different stop losses through time, or through price, I should say. All right, Peter. That's everything for me. Again, we've got like 20 questions in queue. I think that actually they're pretty good questions, so I don't mind sticking around a few minutes to answer them, but I'd love to see, what you want to do at this point here as we wrap up today's session.
Yeah, I think questions honestly is the best thing to do. I mean, our time is you all's time, folks. I know the upper ups have been trying to keep us closer to time, but this is my last session. I'm taking the month of June off for my last bit of time off with my kiddos for paternity leave. So Chase, I don't want to talk out of turn for you, but I'm fine to ride off in the sunset. Maybe take another 5-10 minutes to try to knock out as many of these as we can.
Let's do it.
Let me, if you don't mind, let me maybe just tackle a couple that I had kind of in the cannon, ready to go here. And I'll try to do a few rapid fire mechanically, and then maybe one or two more mentally, and we'll kind of go back and forth. Question did come up. Maybe you had seen the margin versus cash type of trade field that had come through. So if you're thinking about the mechanics and there's different fields that you might notice, like trading on margin or cash, or maybe you're not seeing that, those are different toggles that you can have in your settings, trade, whether you want to see the drop down of cash versus margin. It's probably better served in another session that we have, like the trading for beginners classroom, Annie, but nonetheless, margin capabilities, they can help leverage or magnify your gains. It's a double-edged sword, though. It's going to leverage or magnify your losses as well. Truth be told, settlement times have been shortened up yet again, Chase, right? Just this week, I believe, or past week, settlement times are now reduced. Sometimes a benefit of margin, even if you're not borrowing or using leverage, was to try to get around what were referred to in the industry as cash rules and restrictions, like good faith violations or free rides. But with that settlement time frame getting freed up, that margin versus cash probably going to get back to kind of your dynamics, your comfort level, and a little bit more on that. So I wanted to at least give a little bit of a thought process there. Christine asking a question, maybe somewhat like Dave was. Dave, I might be reading your question incorrectly here. Options opens at 9:30 to 4 p.m. Eastern. That's correct. So, options themselves will be placed during standard hours. There are a few in particular products that will trade a little bit before market or maybe 15 minutes after market. Maybe call the Active Trader Services Group. They can maybe speak with you about the different ETFs or indexes that maybe trade pre or post market, but they are in the minority. Very, very few and far between. There's only a couple options products that do that, or I should say a handful pre market, much less after hours. Christine, what can be traded pre or after hours? I mean, you name it. I'm trying to think about things that really are limited to not trading after hours. As far as your vanilla equities or ETFs, more times than not, those are going to be able to be traded after hours through that directed trade and extended hours portal. I'm thinking about products like mutual funds. Those types of products don't trade after hours, much like the equities or ETFs would be trading. So try to keep those in mind. Dave also asking about any type of practice account. Dave, we have an options, what's called the profit loss calculator. This profit loss calculator really excels for option positions. We don't necessarily have a paper trading account. If for some reason you were looking to try to add a simulated position, it does let you do it for stock. So under the simulated position stock, you could just say, hey, what if I was to maybe buy 10 shares at about 215? Well, if I'm able to get filled at 215.20 right here and now, how would that look versus, with different directional theses kind of in mind? This ticket, or I should say this kind of tool, really excelling for inputs like price, time, and volatility, which are going to be more influential on an options pricing model versus just a stock. But you see how I kind of added this strategy stock in this little icon here, hard to read, but says SIM for a simulated position. So if you are looking to maybe track a potential, you could do that, but it really will excel for options. But just wanted to go ahead and be mindful of that as well. Another question, and then I'll pass it over to you, Chase, if you're ready. Where to pull up the average true range. So under indicators, a couple different indicators that we can use. Indicators, and then you can search for it. You can look alphabetically ATR for average true range. There is the nominal or just the price difference. And you can see, given this Microsoft, it's about 7.31. Well, what does that mean in dollars versus percentage? That's why we were talking about the average true range percent. Okay, $7, that's fine, but it's putting it in this 1.76% kind of range based off of this itself. So indicators, or all things indicators, would be kind of in this here. One other, and that's kind of where I'll stop and pause and kind of re-go back to some of these, was going to be kind of about the statistics of stops versus stop loss versus other types of buy and hold strategies or other types of strategies that use other mechanics for selling. Got to admit, I don't have a statistics diary as to which of these are better or chronicled. I think what it goes back to is there's times when I use a market order. There's times when I use a limit order to either buy or to sell. And there's also times when I'm going to utilize stop orders or trailing stop orders. What we're really here to do is ensure that you're aware of these order types, that you are comfortable with these order types, but then also confident with these order types and when they might fit the mold. Those types of orders are going to be, I guess, really unique to your trading strategy, your style. But I think go back to really what we're trying to accomplish with these. If you have some type of trailing stop on even something like Microsoft, are there going to be some dips? Yeah, I think any stock's going to have some dips or bumps along the road. The point is being able to try to identify when something is actually beginning to retrace. And I think the language was used, when do you know when the bottom is? You really don't. A very, very successful trader that I had known for years told me, I'm never going to be able to find the bottom. I'm never going to be able to find the top. But if I can go ahead and try to get maybe the middle third of a move and do that confidently, I'm going to feel pretty good. And what that means is Here's another indicator I kind of use to visualize this trailing stop mentality kind of on the dop side. It's only moving upwards. This one does retrace, but when you see that retrace, just imagine that's when you're going to be getting out, so to speak. This is a kind of process or platform built off of kind of where pricing was over a time frame versus a percentage retracement. But the point is, when did you know that this was maybe the top short term versus this the top short term? Well, you really don't. You have to be able to try to look for opportunities in a trend, but if that trend begins to test or get invalidated, you got to hope that you were able to go ahead and get part of that move. You didn't get out at the very top, but what made this the quote unquote top, versus this price or this price or this price or this price? You don't really know a top until after the fact. Sometimes folks say it's easier to see, but that's what goes back to, we want to try to make sure that we're in, from the bullish perspective, positions that are taking 2, 3 steps forward, only 1 step back. If it starts to take that second step back, third step back, we wanted to be able to manage risk and then look for maybe an improving technical dynamic. So that's what I wanted to say. I think that was clouding my judgment for so long, was getting out, but then also not knowing when I needed to perhaps get back into a trade. And I think that kind of had me more panic stricken about, well, if I get out now, I'm going to feel like a fool buying tomorrow if it's higher. Well, what if you got out at a certain price point and then got back in? Yeah, maybe you spent an extra $10, but if you made $50 in the process, you're kind of splitting hairs. So reserve the right to, of course, give yourself the ability to get back into positions even when you're getting out. It's all about being able to have some type of mechanics behind how you manage your portfolio in order to try to avoid severe and catastrophic drawdowns. All right, Chase, more long-winded than I want, but I think that's important just from that mentality standpoint. Folks, you can't beat yourself up. You're not going to be batting 100, so to speak, when it comes to trading. The sooner you can embrace that and mitigate those large drawdowns, I guarantee the better trader you're going to be for the long term.
Yeah, 100%, Peter. It's one of those things where the best baseball players still don't hit things 100%. In fact, most of them barely are able to get half, right? And they're still known as legends. And so, as a trader, we're just trying to win a little bit more often than we lose. And when we win, we try to win bigger than we lose. That's all it comes down to. We had a question that came through from LJ, says, hey, can a stop or stop limit orders use different lots? So like tax lots if you're in a taxable account? Yeah, absolutely. From like a versus purchase perspective, you can do that. We do have Citigroup in our test account, just for whatever reason. So if you actually mock it up here in ATP, Citigroup sell, next to where it shows your share quantity here, LJ, there's actually a lots button, LOTS. And if I click on it, I could say, hey, of the 10 shares I want to sell, where do I want to take them from? So if I just say maybe these 10 right here, return to trade, here's the stop. I set my stop to whatever level I want. Citigroup's at $62 a share. Let's just say I say $60. When it sells, the system should be smart enough to then see you've identified those shares. But like always, if there is an issue, of course, you can call us. You can go on the website and do a versus purchase after the fact if necessary. But yeah, you can definitely do that for sure. Now, another question that came through here is when it comes to, and this is a question from Kelly, like what's a healthy stop loss? I know we talked about that a little bit here, but just to reiterate, there's a bunch of different ways that you can do a stop loss, whether it's trailing or not. Some of just the quick highlights that we talked about, of course, is you can use some form of technical analysis if you'd like to. I know we didn't get too far into that today, but whether it's just standard support or resistance levels, you could do something like that. You could use something like a trend line, so more of a diagonal support and resistance. Let's say I connect some of these two prior key pivot points. We draw a line through here and say, hey, if it's below this line, that's a big no-go, right? Maybe you set your stop to where price and time would have intersected, so maybe 245. Well, it still would have been stopped out here today, right? You could do that. You could use a measurement of average true range. So, for example, you could say, hey, I want to stop that's 1, 2, maybe even 3, 4 times whatever multiple of this number to give myself some variability or some wiggle room. So a bunch of different ways that you could do that, Kelly, for sure. Not really a best way, but really what makes the most sense with the kind of trading you're doing. If you're a trend trader, then you're probably going to base your stop upon some kind of technical trend, right? Like, hey, if it breaks beneath this trend, it's a no-go for me. You could obviously pick on a company like NVIDIA because I've seen that symbol come through a bunch of different times here today. And you could even use something like a moving average, right? And just say, hey, I'm going to set my stop loss just beneath the 5-day. If it reverses through, I don't want any part of that. Short-term trend seems to be waning. I don't want that, right? So very, very plentiful in the ways that you can go about establishing them for sure. I think I saw a comment from Kim about CRM. If we go back to Salesforce for just a moment, saying, so I will be much better off if I place a stop limit on CRM 260 than a stop loss at 260 due to after hour activities. So what we're trying to say here, Kim, is if you do a stop loss at 260, let me go back to this chart and we'll just draw a line here. Actually, I'll take this one and we'll call this 260 good enough here, right about there. A stop loss says as soon as the price during standard session hours is beneath it, sell. A stop limit would say, hey, if both numbers on the stop and the limit portion are both 260, then it has to be initially below, but then above 260 to sell, which would not be the case. So in the case of CRM, at least for today, if you had a stop loss, you would have been sold right at the market open. If you had a stop limit in both numbers were 260, you'd actually still be in the position. You still wouldn't have sold at this point in time. So you'd be sort of, with the benefit of hindsight, worse off in this case. Okay, moving forward through just some of these other questions, we had something that came through about, can you cancel a stop loss? Yeah, absolutely. As long as the order is not executed. So let's say you place some kind of trade, right? We can pick on CRM, sell 100 shares. We'll just say a trailing stop loss, or it could be a regular stop loss, no problem whatsoever. Let's say we want a trail amount of $10 starting today. Then the thing starts to move upwards and we say, oh, you know what? Maybe I want to just tighten it up a little bit. You can do what's called a cancel and replace, which would just cancel the old order and let you place a new one in its place. So yeah, you can definitely change these, especially if you have them set to good till canceled, where you expect to have them on for a bunch of days. No problem whatsoever. Looking through here, Anonymous saying, can I manage my alerts at one place? Yes, if you go to alerts, there's a manage section that's going to bring you up to some of the settings. And on fidelity.com, there's like a whole listing of your different alerts as well. I'm not going to pull them up here only because the user, this test account, it's going to show the information for the user. So we're not going to do that here on the live share, but you should be able to do that. If you have any questions, Anonymous, further than that, then we can definitely help you more broadly here at Fidelity. Looking through at Kim's question, where did you get the day plus? So yeah, day plus itself is only going to be available as a sort of criteria or condition within the directed trade and extended hours trade ticket. This is the ticket that you have to use. No questions about it. You have to use on ATP if you want to place a trade that's eligible for execution during some portion of the extended hours. Of course, you can use this order during the standard session, but if you want it for the after hours, you have to use this trade ticket. But there's that time and force. You click on it. Let me make sure here. Sell, route, CRM. Let's see here. Let me set this here to a limit. And if it's going to condition with us, we should be able to get a time and force. But maybe I'm being silly here. Maybe you can help me out, Peter. But in any case, we'll have the ability to, especially if you're pre-market, if you place that day plus, it's good for the pre-market, standard session, and then after hours. That's the day plus specifically when it comes to those limit orders.
The issue there is that the route, folks,
oh, thank you. That's what I'm missing. Yep.
There you go. The directed trade ticket is probably one of the most dynamic tools in Fidelity. And when I just say dynamic, fancy way to say you choose this, then there's going to be other choices. You choose that, then there's going to be other choices. So there are a few routes that are available for that day plus style order itself. And that might be the hang up for many of you.
Thank you, Peter. Yep, drawing a blank. It's been quite the day. I appreciate it. Yeah, Kim, I see your comment. Yep, only when in route. Yeah, see, the thing is when you're doing this in the pre-market or the after hours, you really don't have many choices anyways when it comes to the route. It's not going to pre-fill. You then have to choose from the 2 or 3 drop-down selections that you typically see there. Okay, looking through here, Peter, a few other things that show through that we've already commented on. So there's the trigger question. Someone saying, hey, difference between stop limit and stop from a risk management perspective. Again, I think it just comes down to what is most important. Like, hey, do you want to just get out of the position, just make sure you're good to go? You're probably leaning towards a stop or stop loss. If you want to have your cake and eat it too, you're probably leaning more towards a stop limit. Last thing for me, Peter, and then I'm going to run just because I have the afternoon market briefing right after this here, is I did promise everybody, if they stuck around, that we'd show them some recorded content. So for anyone who's still here, apologize, it's coming a bit late. That's my bad, of course. But let's share some of that stuff. So what can we do? On the website up in the top right-hand corner, we can always search for something here. If you search for the word stop loss specifically, you'll find a couple of useful things. One is this brief little breakdown of different orders altogether. Of course, there's a section for stop loss versus stop limit. There's a couple of FAQs and a link to our 4-week class. That's a good place to start. Scrolling down, there's some videos. I'll be honest, folks, I think some of these videos are kind of old in terms of the like the marketing and the video editing. So if they seem a bit we'll just say outdated, forgive us. We're getting around to updating these in general, but the content would still be relevant. A stop loss really hasn't changed in terms of what it does. A few other videos and articles available too. So I would just encourage you to maybe check out some of these uh, links for additional resources. The second thing I'll add, it's a little bit off the beaten path, but it's similar in nature, is if you go to our learning center, so the same kind of overarching place you went to sign up for the session. So learn, go to events, and then on demand webinars. So Learning Center, events, on demand webinars. From here on a landing page, if you go to the options section, so you kind of have to scroll a bit. There's these little, what do they call them? Like a carousel kind of wheel icon, this little arrow. You got to click through to scroll. And at the very end, it says protecting your investments with hedging. If you click on it, it will pull up a recorded webinar. It's not entirely about stop losses, but me and James Savage, another teammate of ours on the Trading Strategy Desk, we did this webinar about a year or two ago. Wow, almost 3 years ago now, 2021. Um, Time flies. But this talks about stop losses and options to hedge your portfolio. These kind of conversations typically go like pretty naturally hand in hand. And so if you are a little bit more intermediate or you're interested in options, in addition to stop losses or some of those risk management orders, I would encourage you to maybe check this out as well. It's free. It's about an hour worth of content you can watch at any time. So you do have access to some of the slides there too, which will talk about some stop losses. Peter, that's everything for me. If you want to stay a little bit longer, that's cool. I do have to run though. There's another session I got to get ready for. Thanks everyone for letting me be here with you today for this hour yeah, almost an hour and a half. So I appreciate it, though. Good to see everyone. Take care.
Yeah,
Peter.
I'll grab it for just a second, then we'll let folks get out of here. This is far past we had expected, but that is a great session that Chase was just talking about and referring to. And reason being, I know lots of the questions that came up were about being able to try to give yourself some protection when it comes to gaps. And if you sometimes want or need that type of protection, maybe it's going to be a different product. And in that hedging, they talk about the stops. They also do talk about different order types, and they actually give a little bit of an introduction to hedging, maybe with options. The other series I wanted to point out is that we do have a kind of pre-recorded version of the 4 weeks trading basics classes, it was called. And this goes back to when I was answering a question about kind of cash versus margin and other trading activities. There's kind of a condensed version of managing risk and exit strategies. That'd be another good refresher for folks if you want to look at different examples on stop orders, trailing stop orders, or maybe being able to implement some technical analysis. This week 4 would be the best bet. And the way I got to this, it's kind of a mouthful, but trading basics, what to know. Trading basics, what to know. And what that will do is then bring you online the, I believe, second link downward, trading basics, what to know before getting started. That would be that video series that I was just referring to. I think one of the last questions I'm going to answer, Anonymous was asking the number for that stock trading desk that I was referring to. If you're ready or you want to take this down, that number is 877-907-4429. Once again, 877-907-4429. We get you to the Active Trader Services Group at Fidelity. I worked there for a number of years, quite some time ago. And they would be fantastic to go ahead and speak with about the kind of the uniqueness of your specific account, or maybe even being able to kind of walk through a couple of these order or trade types if you were looking to try to take your hand in. All right, we'll close it out. Like I said, far longer than we had planned on. Appreciate all the well wishes. Don't miss me too much. Like I said, it's going to fly by, I am sure, but looking forward to that last bit of time that I have there. So I will be out for the month of June, but you all are in great hands here on the desk. Thanks for spending not just some of your time, quite a bit more time maybe than you anticipated. Hopefully, you found much of this helpful, as I talked about previously. Not necessarily that you're going to be placing this trade every single time you go to make an investment or make a trade, but utilizing these order types if and when the situation presents itself, or maybe in order to go ahead and take some of that mental fatigue off your plate, could go a long way. So, thanks again. You all enjoy your afternoon. Pop into that afternoon market briefing. They will break down the day's action. Take care, everyone. I'll see you soon.